And today was a big day for economic indicators. We had some jobs data coming out. So we'll take a bit of a deeper look into that. And for those of you that are new to the non-farm payrolls numbers or the unemployment rate numbers and how they can impact the market, I'll also be taking some time to explain just how they impact the markets. Okay, so on the first Friday of every month, the Bureau of Labor Statistics, BLS for short, releases what is known as the Employment Situation Summary. So this is simply a report made up of two surveys, one being the household survey and the other one being the establishment survey. So when it comes to the household survey, there are a few components to it, but the most important one is really the US unemployment rate. The participation rate as well can be quite important, but most people look at the US unemployment rate. So the rest of the components are basically breakdowns of the US unemployment rate based on certain demographics. So we had unemployment numbers come out just 15 minutes ago, and I'm just looking at the data here, which is quite interesting. The first thing that we need to know is that the previous unemployment number for last month, for April, I should say, was 3.4%, and the analyst expectations for this month was 3.5%. The actual number that came out was 3.7%. So that's quite a significant upward change here for the unemployment rate. And what does that actually mean for equities moving forward? Well, as you can see here, we have the chart for the unemployment rate over the last few years. And naturally, during times of economic distress, unemployment spikes up higher, especially during COVID. It spiked up quite significantly higher, but also recovered at a very fast rate as well. So last month's, and I should say as of today, this month's unemployment rate coming in at 3.7%, a little bit higher than the 3.4% from last month, means that this chart will move a little bit higher as of today. But what exactly does this all mean, and how does this impact equity markets in particular? Well, unemployment, you generally want to see that being lower, on the lower end of the spectrum, because obviously with high unemployment means a weakening economy, and lower unemployment means a strengthening economy. However, when it comes to the last year, maybe year and a half, that hasn't really been the case at all. There's actually more of an inverse correlation relationship, because the main theme of markets over the last couple of years really has been inflation, persistently high inflation. Obviously, the main source of that was the COVID pandemic. But what that means is that when unemployment is low, it means that there are plenty of jobs available, and that you tend to see workers getting paid more, right? So if we take a look here at the unemployment spike from COVID, and the current levels are now back to pre-pandemic levels, which is around 3.7%, and the long-term average is 5.7%. So it's still significantly lower than its long-term average. So this indicates, a hot economy in terms of a hot labor force, but that may not be a good thing, because that leads to inflation. We know labor inflation has been a key contributor to inflation, and the Fed won't really want unemployment to be too low. They actually prefer unemployment to be steadily a little bit higher, because it gives them more slack when discussing what to do with interest rates. So the unemployment actually moving up this morning. Traditionally, it may be negative news for the economy. However, when it comes to equities, you may find that will be positive news, because it means that it gives a green light for the Fed to be a bit more dovish, or it gives a green light for them to not increase interest rates at the next meeting, which is going to be naturally a tailwind for equities. So, very interesting to see the unemployment rate jump up a little bit higher, especially when it's so low. But that is good news with regards to labor inflation. Now, the second important economic indicator from today was the non-farm payroll. So that has to do with the establishment survey, but that's more commonly referred to as the non-farm payrolls, or the NFP reports. And non-farm payrolls measures the number of workers in the US, except from farming, private households, proprietors, non-profit employees, and active military. And that basically reflects roughly 80% of the workers in the US. So overall, non-farm payrolls has been trending lower which is what the Fed wants, because if you get more jobs in the economy, what that means is more jobs means that there's more competition for companies to hire workers, and therefore those workers will be paid more. And that would again be a key contributor to labor inflation, which is something that the Fed does not want. So by hiking interest rates, there will naturally be lower jobs available. And so far that has been working. Yes, there's a few spikes up higher, June 2022, Jan 2023 as well. But overall, the trend is moving lower here. Now, the analyst expectations for non-farm payrolls was 180,000 jobs to be added last month. So that would have been a lower number than the previous month as well. However, the figure that actually came out was just under 340,000. So that is a huge jump in non-farm payrolls. And that would mean that the economy has added a lot more jobs than expected. And that would be a key contributor to inflation. So on one hand, you have high unemployment, which should help reduce inflation. But on the other hand, you have high non-farm payrolls, which should help increase inflation. So today's report was very, very ambiguous. And it'll be quite interesting to see what happens at the open regarding equities. That being said, futures have actually reacted on this, quite positively to this news, inching a little bit higher over the last few minutes. But again, and that could change at the open. Now, it's difficult to say why futures are moving higher, but my best guess here would be due to the fact that wage growth has actually been quite stagnant during this report, meaning that, yes, even though non-farm payrolls has increased, that might only be reflecting lower paid jobs. So that wouldn't have as much of a negative impact on inflation. So that is one of the reasons why I do think that equities are actually not viewing this in a negative light. Because traditionally, if non-farm payrolls is higher, yes, traditionally that's good news. In today's economy, that's not good news because it leads to inflation. It gives a green light for the Fed to increase interest rates or keep them elevated for a bit longer, which is a headwind for equities. However, if wage growth has remained stagnant, that would essentially cancel out the negative effects of a higher than expected non-farm payroll number.